Hello, everyone. Good evening. This is Waris Karim with yet another presentation on financial accounting. We're still doing financial accounting. I promise that I'll switch over to managerial accounting soon after maybe just two more presentations. So my accounting 219 students, my managerial accounting students, please hang in there. I know you've been waiting for quite a while, for several weeks now, at least a couple of weeks, for your turn of the discussions. But I'm almost done with financial accounting. So this one, and then maybe one or two more. Anyway, so tonight's topic is accounting for accounts receivable, or accounting for receivables. We're going to include the issues like what happens when you make a credit sale, and what happens when the customer doesn't look like in the mood to pay. What happens when you set aside a certain amount of money, anticipating future non-payment, future bankruptcies, future non-compliance by your customers, bad and doubtful debts. Or what happens when someone that you thought are not going to pay, when they come back, when they resurrect. So that's like life after death. So those reversals. Also, there are a couple of methods. For example, the direct write-off method of writing off bad and doubtful accounts, or the allowance method, the one that is more scientific, more sound. And within the allowance method, there are two variants: the percentage of sales method and the percentage of receivables method. All right, now, before I begin my discussions, I would like to ask you one thing. I'd like to ask you to stay home, stay safe, because tonight is a bad night. The United States has touched two grim milestones, crossed two very grim milestones. One is, for the first time since the coronavirus pandemic started, we are experiencing more than 2,000 deaths in one day. So just about a couple of minutes ago when I checked, the cutoff time, 8 o'clock here, it has already crossed 2,000 deaths. That's 2,000 homes, 2,000 families, 2,000 dining tables, 2,000 chairs are going to be empty. So we pray for those who are still struggling, who are still in ventilators, who are still in ICUs, who are suffering. And of course, my heart goes out to the families of those who departed. And I pray to God that those who died, those who left us because of this pandemic, that they have the best possible entertainment from the Lord, best possible reception, best possible place in heaven. Amen. And my home country, Bangladesh, also is experiencing this spike, the so-called second wave. The number of deaths and number of positive infections, both the numbers have been on the rise in the last couple of days, last week or so. So this is all of us, the whole world. I think also another thing, for the first time since it started a year ago, nearly a year ago, about 10 months, the total number of deaths worldwide has crossed the 10,000 mark. 10,000. For a long while, 3,000 used to be considered to be too bad. 3,000 deaths in one day. But in the last couple of weeks, it's been on the rise, and today we have seen more than 10,000 people. So this fatality is unprecedented in the last 100 years or so. And as my students, my friends, whoever is watching it, life comes first. We have to be alive, we have to be safe, we have to be healthy. And who knows, by next year this time, I may not be around. You may not be around. So watch out your family, your friends, your close ones, your dearest ones, and watch out for everyone that you care about, and pray for the mankind. for the human race. Amen. Okay, so turning back to accounting, there's livelihood, so someone has to do it. But I enjoy accounting. You know that although I'm a student of finance, I like both finance and accounting, and I like issues that require judgment, issues that make you think. So accounting nowadays is not just a matter of debits and credits. Accounting is more of an applied business acumen, applied business skill. All right, so accounting for receivables, I would like to start with this accounting cycle. You can see receivables accounting cycle. So it starts with how accounts receivable is born, how it's born. It's born with credit sales. So whenever you sell something, if you collect the money, if it's a cash sale, you debit cash, of course, cash coming in, money coming in, cash debit. And when money doesn't come in, something else comes in, IOU, either a verbal promise or when there is a paperwork, when there is a signed IOU, we call it notes receivable. So you create another asset, not cash, but you create accounts receivable when you make a credit sale. So you create either accounts receivable or you create a notes receivable when there is an IOU. So when there is paperwork, then we call it notes receivable. But when there is no paperwork, if it's an open account, like based on your good faith, you're selling to your customer, and the customer says, yeah, customer may have a line of credit with you. So those are accounts receivables. Anyway, credit sales create accounts receivable. This is how accounts receivable is born. All right, so we start with credit sales, and then we go for allowance to guard a fraction of those receivables that are unlikely to be collected, because there is always this uncertainty. You have to weigh in the possibilities of non-payment, but you still have to extend credit, because for many businesses in many industries, it is impossible to do business without extending credit. Say, for example, Airbus, A380, those great jumbo jets that they manufacture and sell. So how can you find an airline who is willing to pay for it for cash? So those large, big ticket items like aircrafts by Airbus or Boeing, major construction works, even apartments. When you buy an apartment, how can you buy, how many people buy their homes for cash or their automobiles for cash? So credit is part of business. Credit is the language of today's business. Without credit, no sale. When we were young, we used to see in many shops, it would say to avoid to avoid customers who would ask for credit. They say, well, please don't make us feel ashamed. Don't embarrass us by asking for credit. So no cash, no sale. But nowadays, no credit, no sale. Even universities allow you time to pay their student loan. There are so many arrangements. So any time, farmers who sell wheat or any of those large commodities, oil companies, everywhere. Anyway, I'm not here to talk about the beauty of the wonderful world of credits. We know it's not a wonderful world. The last financial crisis was, to a large extent, was triggered by reckless credit. But nevertheless, credit is unavoidable. It is indispensable. All right, so now we have a credit sale, then we have an allowance for doubtful accounts based on some prior estimate, prior research, and then we have to write off if we find that there's a customer or a couple of customers who we know that for certain that they're not going to pay, so we write them off, and then we make a collection. So this is the cycle. You start with a credit sale, create an allowance, write off, collect. Sometimes the ones you have written off, they could come back to pay. All right. So I call it accounts receivable accounting cycle. Perfect. This is my first slide. How accounts receivables are created. So I already said that they are created by credit sales. So whenever there's a credit sale, you can see credit sales create accounts receivable. So what's the journal entry? If they're backed, as I said, if they're backed up by an IOU, a signed paperwork, then you call it notes receivable. Call it notes receivable. All right, so we have a credit sale with debit accounts receivable here. You can see we have a credit sale, debit accounts receivable, and credit sales. So that's $100 transaction. And then when the customer pays off, when they pay on time, then we say debit cash and credit accounts receivable. So money comes in against another asset. So accounts receivable goes away, cash comes in. But what if the customer doesn't pay on time? Or what if we start doubting the fact that the customer will ever pay? So what happens when that happens? We have to prepare ourselves. So bracing for the uncertainty, bracing for the disaster. Well, it's not quite a disaster, as I said. If you can manage it carefully, then your sales would still be on the rise, and your accounts, bad and doubtful accounts, would be under control. So that's how you manage your credit. How you manage that depends on your credit team, your sales team, your collection team, your how the effectiveness of your screening system, screening mechanism. So that's totally a different domain. Our part today is only to look at the accounting side of it, how we account for it. All right. So see, we have two methods to deal with those doubtful accounts, deal with those so-called bad accounts. See, there's a difference between bad and doubtful accounts. Bad means that we are pretty sure, that we are not going to be receiving the money. So this happens when we specifically know the parties, when you know specific customers, customer A, customer P, customer Q. So 3 customers in total, say, responsible for $10,000 have been determined, have been established to be bankrupt or to be uncollectible. That's when you call it bad debt. Bad debt. But doubtful is a bigger chunk. So when doubt starts brewing, you don't need to specifically know who the customer is going to be. So you could have millions of dollars in total accounts receivable, and of that you could think that maybe 3 to 4% could be doubtful. So, and also the level of doubt starts rising when the account starts getting overdue and overdue and overdue. So 30 days overdue versus 90 days overdue versus 180 days overdue. So the longer, the older you are, the less likely you are to remain compliant, to be paying your dues on time. All right, so we have 2 methods here. One is called the direct write-off method, and the second one is the allowance method. Within when you apply the allowance method, then there is an extra job here. You'd have to estimate. You have to estimate the amount that you would be setting aside. Estimate the allowance, the amount of allowance that you would create or you set aside to face possible non-payments. So remember, the allowance method means there is an early warning here, or there is a precaution. So we take a precautionary measure. We already in advance we set aside some money, like in a cookie jar, anticipating non-payment, anticipating non-compliance, default, anticipating credit default. So when the default occurs, we already have some money there to back it up. So we use that allowance when default occurs. So that estimation is based on 2 methods. There are 2 ways you can make that estimate. One is called the percentage of sales method, and the other one is called the percentage of receivables method. So in total, you can see 4. I mentioned 4 methods. One is the direct write-off. Second one is allowance. But these 2 are actually sub points, variants under the allowance method. Because the allowance method can be implemented either via the percentage of sales method or the percentage of receivables method. So some textbooks call it account analysis of accounts method. Analysis of accounts method. All right. And as you can see here, account analysis method or by means of an aging schedule. So sometimes we prepare that aging schedule. Okay, so this is a scheme, a framework of all the methods in one slide. You can see here. So please take a careful look. I'll hold it for a few seconds. At the top, you can see there are two methods here, the direct write-off and the allowance methods. And under the direct write-off method, this is what we do. We directly write it off. So we do not create an allowance. We debit bad debt expense. We debit bad debt expense and directly hit accounts receivable. So our asset, this asset is directly hit. So if a customer or two customers are identified to be defaulting, then we debit bad debt expense. We recognize an expense upon discovery, upon identification, upon determination. We talk about the issues that come with it. So the bad debt expense is debit and credit is accounts receivable. So you can see an accounts receivable is an asset. So when an asset goes down, we credit it. So your accounts receivable account is down, your expense is recognized. Under the allowance method, as we have seen, there are two ways you can implement it. Or for estimation purposes, you use either percentage of sales or percentage of receivables. Under percentage of sales method, you identify or estimate the total amount of allowance based on a certain percent of your credit sales. So if you know your annual credit sales, you're now in a position to create that allowance. So let's say our sales, which I mean credit sales, is at $500,000 here. So from $500,000 of sales, we create an allowance of 1.25%. So 500,000 times 1.25% gives us $6,250. So that's the estimated amount that we need to set aside. See, $6,000 of bad debt or $6,000 have not been defaulted yet, but we are setting aside that money. So we recognize bad debt expense and create here, you can see, credit allowance for doubtful accounts. ADA, I'm going to call it ADA. In the United States, in America, we call it allowance for doubtful accounts. In New Zealand, England, in those other British Commonwealth countries, we call it provision for bad and doubtful debts. Provision, they use the word provision, they or I or we used to use provision or allowance. Yeah, I mean, nowadays, many countries are becoming increasingly Americanized, like Japan and Australia. So, don't bother about the semantics. I just wanted to integrate those who are following or who would be watching this video from outside of the US, that this ADA is more America-centric. Allowance for doubtful accounts. Every textbook, you have to follow the norm. So I'm acclimatizing with this allowance for doubtful accounts. Anyway, so we create this allowance for doubtful accounts. So that's a credit balance. The more money there is, the more credit is going to be. So this is a cookie jar reserve. This is an example of provision for warranties or allowance for warranties, allowance for anything, allowance for bad and doubtful debts, provision for taxation, provision for anything that you'd like to create. All right. So expense has already been recognized. So please see the timing. No one has become bad yet. Technically, it is possible that no one has been determined to be defaulting. We don't know. We are not sure about any default yet. We still are setting aside $6,250. So this is very conservative accounting. And conservatism does require anticipating all losses, anticipating no profit. Remember the old adage, anticipate no profit, but provide for all possible expenses. That's what is the slogan of conservatism. All right, so we are doing that here. We're not anticipating that everyone is going to be in their best behaviors and everyone is going to come back with an envelope full of money or checks. So some are notorious. Some would be with, in spite of their best intentions, they would not be able to pay on time, or they would not be able to pay at all because of bankruptcies or health issues, that their business might go down. there are so many reasons why businesses fail. So if they fail, if the whole business fails, then how are they going to pay me the dues? So it is possible for even the best people, best type of businesses to default. All right, but we are setting aside the money here. So the more money set aside there, the bigger would be the credit balance. Just remember. All right. Now under the one more point about the percentage of sales method is that the amount that you see, the amount that you calculate here, say 2% of your sales or 1% of sales or 3%, whatever percent of sales, the amount that you compute is exactly the amount that you plug in the adjusting journal entry. In the adjusting journal entry. So no difference, you can see 6,250 is the amount. 1.25% of $500,000 is 6,250, and that's the amount in the adjusting journal entry. Bad debt expense, credit, ADA, same amount. The more sophisticated method, or the more beautiful method, is the allowance, the percentage of receivables method. See what's happening here. Under the percentage of receivables method, we first estimate a certain percentage of our total accounts receivable. If our receivables is, for example, here, our total receivables is $75,000, and we estimated that 6% of those, of the $75,000, is the desired amount that you'd like to see in the provision account, in the allowance account. So underline the word desired. That's what we desire. That's the expectation. All right, so let's count. Let's compute 6% of 75,000 is $900. 6% of $75,000. 6% is, well, 6% is not 900. 6% is actually $4,500. Yeah, I'm sorry. So 6% of 75,000 is $4,500. That's the desired amount. Now, of the desired amount, we are also told that our ADA account, the allowance or the cookie jar, the pot, it has $900 in it. So there is some money saved there. How much? $900. So watch this. ADA balance, presumably a credit balance, is already $900. So we have $900 there. Now my desire is to have $4,500. So how much more I need? You calculate. You have a target of $4,500. You already have $900 there. So I don't need $4,500 to make it $4,500. I already have $900. So adjust that $900, and the remaining, so $4,500 minus $900 is $3,600. So the adjusting entry is going to be for $3,600. See here, I've done some little bit of a note here from down under. So the adjusting entry, the bad debt expense, is for $3,600, not for $4,500. And ADA is credited by 36. So we've already got 900 there, plus 36 will add up to $4,500. Can you see it? Now, you could say that, okay, under the other method, the percentage of sales method, what if we had some balance there too? We would probably, if it's a going concern, unless it's a new business or it's the first year, we would have some balance there, debit or credit. So let's say we have same $900 credit balance there. Regardless of the balance of the ADA account, debit or credit, whatever the amount is and whatever the direction is, no matter how much you have there or if you have anything, the percentage of sales method does not make any adjustment to the amount computed under the percentage of sales. So 3% of sales or 1% of sales, if that computes, if that results in $6,250, then that's the amount that you have to provide for. No adjustment. Remember? So the adjustment only comes under the percentage of receivables method. On the percentage of sales, the amount that you compute, the direction is say 2% of sales. Your job is to provide for 2% of sales as fresh provision, as fresh allowance, even though there are millions of dollars there, doesn't matter. All right. But under the allowance for percentage of receivables method, the computation first says 6% of accounts receivable. That only gives us the desired balance. That is what the expected or the target balance is. That's so to achieve the target, if I need to set aside on all $7,500, I would set aside $7,500. Like here, sorry, $4,500. But if I don't need $4,500, if I have already say $900 or even $1 there, if you have a dollar credit balance in the ADA account, then do not set aside another $4,500. Set aside only $4,499. So that after the adjusting entry, after everything, you still have that desired amount sitting there. All right. So that is, I think, that was important, because this is something that bugged me for years when I was a student. It used to bug me for years. All right. Now let's go over some of the issues, practical issues or conceptual issues of the direct write-off and the allowance methods. So under the direct write-off method, so please read what I said here. As soon as it is determined that an account has become uncollectible, see, not has become doubtful. You don't do anything when it is doubtful. So when the doubt starts rising and it gets to a level that you think that it is uncollectible, so you determine it or you judge it to be uncollectible. You tag it as uncollectible, then you recognize an expense. So debit bad debt expense, credit accounts receivable directly. You can say no allowance is created. So these are the features. No allowance is created. Write-off upon discovery that it is bad or it's turning bad. Next, it could breach. Could breach, it not just actually could, it is going to breach. It does breach the accrual concept, the accrual principle of accounting. Now, everybody knows the accrual principle. Accrual concept or accrual principle says that your revenue and expenses and associated expenses must be matched. There's also matching principle. The accrual principle says that whether it has occurred or not, if it has accrued, if conditions exist, like say I've been selling a particular commodity, say I sell books or I sell my accounting lectures, and I've been selling for say last several months, and thousands of dollars are in the market, my credit, and I know that some of them are not returning my calls. Some of them have become 30-day overdue, 60-day overdue. So can you see the conditions are being created for a storm of non-payment? So there would be default. So accrual principle says that I don't have to wait until someone, totally disappears, someone becomes bankrupt. So whenever they're late, I must start recognizing my expense, because my time is going away. So if my sales occur in 2020 or sales occur in the first quarter of say 2020, associated expenses related, relevant expenses that are linked to that revenue must also be recognized in the same period. And this is an expense. Bad debt expense is a legitimate expense. It's a real expense. If someone buys my commodities or my services and don't pay, then it's almost like I'm spending money to pay for the entertainment, or I'm buying that item for them, which I don't mind if I can afford. If they're friendly, I do that. Sometimes we do it as a promotion, but you don't want to spend your money on customers who are not going to be returning customers. So this is a cruel reality of life, that the so-called bad customers or non-compliant customers, the defaulting customers, are living off the good customers, best customers. So the ones who are, how do we survive as a business? The ones who are paying us on time, they're the ones who are running our business. They're the ones who are supplying with the money, the revenue, the cash that we use to pay for our purchases, to manufacture new items, to replenish our showrooms, to pay our employees, to pay wages, to pay our rent and salaries, and everything else, insurance, whatnot. All right. I have a tendency of distracting. All right. I realize that, and I hope I'll be able to correct it. But some of my students like it. They like me go off track, and sometimes the issues that I bring in when I'm apparently off track are the ones that make sense to people, are the ones that you can make ready reference to. Because accounting has one perennial problem, that many things we do in accounting do not have a ready reference in life. All right. So let's sorry about the blip. So let's see the other conceptual issues. So I said that it actually not just could, it doesn't, it does breach the accrual principle. Why? Because the conditions existed already, and maybe 2 years later or 9 months later, you discover that they're not going to pay, and that's when you recognize the expense. That's when you recognize bad debt. You should recognize it as soon as simultaneously with the sales. So when revenue is recognized, associated expenses like cost of goods sold, sales and cost of goods sold, they go hand in hand. Cost of goods that are sold. So bad debt expense is also a part and parcel of that sales. Because of those sales, I had a couple of hundred customers in January, and if 3 of those customers don't pay, then that expense should be charged in January against my January sales, if we have monthly income statements. So fortunately, we don't do monthly income statements, but most businesses do quarterly income statements. So it should be reflected in that quarter, or at least in that year. All right, so direct write-off method doesn't support the accrual principle or the matching principle either. All right. So we say that it could breach the accrual concept, and timing mismatch. You can see timing mismatch can occur, sale in one period and expense recognized in a different period. So please read it. Sale in one period, but expense recognized in a different period. So it leads to a mismatch between revenues and expenses. So bad debt, the direct write-off method is not conceptually sound, but for small businesses, or when you have difficulty estimating, or maybe at the beginning of your business, you can apply this method. Now, one more journal entry. So we have an entry for sale, make a credit sale, debit accounts receivable, credit sales. Then the customer pays, debit cash, credit accounts receivable. And the customer doesn't pay, debit bad debt expense, credit accounts receivable. So this is how you clean up your accounts receivable. All right. Now, what if the customer that I thought won't pay, the so-called bad debt customer or defaulting customer, turns out to be a good customer, and they come back maybe in the next period. So what if they resurrect? So we have to reverse that bad debt expense. The entry is simply, there'll be 2 entries. First, you have to reestablish, you have to reinstate the customer into your accounts receivable and then collect. Unless you have an accounts receivable, you cannot collect it. So there are 2 entries here. One is simply reversal, just reversal of the bad debt expense entry. Remember, the entry was debit here, debit bad debt expense, credit accounts receivable. So if you reverse it, what will happen? You debit accounts receivable and credit bad debt expense. So I'll say debit accounts receivable, credit bad debt expense reversal. All right, and then you debit cash and credit accounts receivable. So collection is made. All right, now what if we follow the real method, the beautiful method called the allowance method? So it's creating an allowance, and if you do create that allowance, your revenue and expense, revenue, which is sales, and expense, which is bad debt expense, they're recognized simultaneously in the same period. So they are reflected in the financial statements in the same period. Sales in 2020, associated bad debt expense also in 2020. Remember, bad debt expense is the amount that you're going to provide for. Bad debt expense is recognized as soon as you create the allowance, not when you find out that someone is defaulting. All right. Second point was, it is consistent with the accrual concept. Fine. It makes expense monitoring easier. You can monitor your bad debt, your allowance account You can see how much allowance you have to create and how much money is still there. So monitoring is possible. And you can see when you run out of money from there. And so that also enhances your quality control. You can revise your credit policy. You can revise your collection policy. You can pay more attention to credit customer screening, or you can revise your customer screening methods. So there are a lot of managerial implications of the allowance method, and all of them are positive implications. Okay, so makes expense monitoring easier, or credit monitoring, and also it avoids earnings volatility. Because earnings volatility, so every time, for example, in year one, I just kept selling and selling and selling, and we have been aggressive in extending credits. So you aggressively sold, so your sales rose, and of course accounts receivable rose as well. But then say 3 or 4% or maybe 30% of those accounts receivables are now defaulting. So year one looked like a great year, then year two would be a dull year. You have everything sagging. So you don't want that. We don't like earnings volatility. Market doesn't like our earnings volatility. Our shareholders don't like it either. Okay, so we like the allowance method better. So let's see how we implement it. Allowance method, as I told you, has two variants. So we're going to start with the percentage of sales method. Here, you can see the accounting cycle using the percentage of sales method. So first, let's have a sales entry. So debit accounts receivable, credit sales, isn't it? The first one, $1,000, and then estimate your uncollectible account, or estimate doubtful account. Don't call it uncollectible yet. Estimate your doubtful account. So now estimation is based on your past experience, because you don't, one would expect you to know the customers, or the industry, that there are 10%, 5% of these customers don't ever pay. Not 10% of customers, remember, it's 10% of the total volume of sales. It could be just one customer. So if you have concentration, that's when it's a trouble. That's why you have less risk when you have diversified customers. You have thousands of customers. But if you have only 3 customers, each accounting for say 30, 40, and 30% of your total revenue, then if one fails, then there you go. You have 30%, a third of your revenue is like starving for 4 months of the year. So when you say 10% of sales, it's not 10% of our customers. It's 10% of our total sales revenue, total sales volume are going to be uncollectible, doubtful. All right, so 10% of sales here, $1,000, 10% is $100. I just made it a round figure. So $100, see the entry is bad debt expense. Debit bad debt expense, we don't know yet who is defaulting. We don't know the defaulters yet. We have been anticipating that 10% of our total revenue will be, let's set it aside to face any unforeseen events, any unforeseen incidents of non-payment. So debit bad debt expense for $100 and credit allowance for doubtful accounts. So the allowance has been created and expense has been recognized. So how much money you have in the pot now? The cookie jar, we have $100. I'm assuming that we didn't have any prior balance. So we have $100 there. Now a customer, you can see a customer called David Jones. David Jones, the great retail store in Australia. That name popped up. So a customer called David Jones is determined to be uncollectible. And they were not determined. We determined them to be uncollectible. We've established, based on the facts and circumstances, we now think that we need to write him off. All right, so when you write him off, no more expense. Luckily, no more expense. Expense has to be recognized when you created the allowance. When you create the allowance. When you fill the cookie jar, now it's time to eat out of the jar. You see? Like when you buy popcorn, that's when you spend the money. But when you're watching a movie and now have your popcorn, enjoy your popcorn, that's when you don't have to pay again. So don't double count. When a customer is established to be in default, or when you have decided to write them off, then write them off, but without recognizing a new expense, because we have already got some money there in the allowance account, unless and unless, of course, the customer is too big that we don't have enough money there, then we'd have to replenish the cookie jar. All right, so a customer called David Jones has been established, has been deemed to be uncollectible. So now we are going to debit, we're going to use the money that we have in the cookie jar. Cookie jar is the ADA account, the allowance account. Allowance is a cookie jar. That's a reserve account. It used to be called bad debt reserve, bad debt provision, bad debt allowance. So it's a reserve account. We have money there, saved there. Okay? So debit your allowance account, debit ADA, and credit accounts receivable now. Accounts receivable with a hyphen, David Jones. All right, so $70 is being used from the cookie jar. So if we need to know the balance now, balance of the ADA account is $30. Still have $30 there. So we have taken the money out of allowance account. You can see debit allowance for doubtful accounts, $70, and credit accounts receivable hyphen David Jones, 70. Now the ADA balance, as I have shown here, the ADA balance is now $30, and the NRV, what is NRV? Net realizable value. Net realizable value of our accounts receivable. So NRV is now $900. 930. So our accounts receivable was 1,000. Remember, accounts receivable was $1,000 minus the 70. David Jones is their name is struck off. So 1,000 minus 70 gives us 930, and from 930 we subtract the ADA balance. Remember, NRV, net realizable value, is equal to accounts receivable balance at any point in time minus ADA balance at that point in time. That's NRV, net realizable value of your accounts receivable, is equal to accounts receivable minus allowance for doubtful accounts. So accounts receivable now, we don't have $1,000 anymore. It is 930 after David Jones' name has been struck off. So that's 930 minus another $30 of balance there. So $900 is the NRV, net realizable value. All right. So that's percentage of sales method. Remember, percentage of sales method doesn't care about the ADA balance. And that's why we didn't, the example didn't include an ADA balance. But I think it would have been a smart idea to have an ADA balance and then showing my audience, showing you guys that, look, we are not going to pay any attention to the ADA balance. We are told that take 6% or take 10% of your sales. Our sales was $1,000, 10% was $100. We just recognized $100 of expense. So that's how we, remember, even if there was an ADA balance, we wouldn't care. We wouldn't take it into account. Now we would. Here we would. All right. So now we have the allowance method, the second variance of the allowance method, which is the percentage of receivables method. This is where you have to dig in a little more, and you have to be prepared to enhance your knowledge or challenge yourself that what you're doing here. So see, under this method, the allowance is estimated as a percentage of accounts receivable. So it's usually done at the end of the period, because that's when you know the total balance of, we know the balance at any point in time, but usually it's done at the end of the period and by virtue of an adjusting entry. So imagine yourself that you are at the end of an accounting period, either a quarter or a year, a quarter or a year, and you have your accounts receivable balance there, whatever the balance is. And remember, there would be, throughout the year, you have written off many accounts. So the accounts receivable balance that you now have is post all those write-offs. So all those, every time you write someone off under the allowance method, you would be hitting the accounts receivable account. So accounts receivable would keep going down as you write off more and more customers, more and more defaults. Anyway, so let's say at the end of the period, we have whatever balance it is, X dollars, and we are instructed by the board of directors or by the chief accountant or the accounting team has decided that would have to write off, say, 15% of our total accounts receivable balance. It's usually done for large companies in the by means of an aging schedule, through an aging schedule. So that's another tool that we'd like to introduce and I'll show you. So that's the desired balance. You can see first we said allowance estimated as a percentage of AR, but that number, that amount is a desired end of the period balance. That's what we like to see when you close our accounts. So, like the balance sheet is going to show accounts receivable less allowance for doubtful accounts. So that amount is going to be this percent of accounts receivable. So that's the desired end of the period balance of ADA. That is not necessarily the adjusting entry number. That's not necessarily the adjusting entry amount. That's the desired balance, ADA balance. All right, so remember that. And then actual allowance, we're there now. Actual allowance created, i.e. the bad debt expense recognized, actual allowance created or the bad debt expense recognized during a period depends on three factors, three numbers. One is the beginning balance of ADA, beginning of the period balance of the allowance account. So ADA is beginning balance, factor number one. Factor number two would be all the bad debts written off during the period. Period, see, not a point in time. We're making the adjustment at a point in time, but we had a period behind us. And throughout the quarter or year, say, we have already written off 5 customers totaling, say, $50,000. So that's another factor. That's another number that we're going to factor in. First factor, first number or factor that you need to factor in is the beginning ADA balance. So beginning of the period ADA. Second factor is total amount written off throughout the period. And the third factor is the desired number. Okay, desired number. So let me quickly write those three numbers. Say the beginning of the period ADA, say January 1 was, say, $5,000. See, beginning of the period ADA is, say, $5,000. And you have written off during the period is, say, $4,000. So you began the year with 5,000 and you wrote off 4,000. So that means you have already used up 4/5 of the cookie jar balance, cookie jar number. So how much you have there still remaining at the bottom of it is $1,000. So that's the balance just before making, replenishing, before making new adjustments. So I have factored in two numbers so far: beginning of the period ADA, which was 5,000, beginning of the period ADA 5,000, and amounts written off 4,000. And now I have $1,000 there, but what's my desired amount? Let's say my desired amount is $15,000. I'd like to see $15,000 there in the jar. $15,000. So if you have $1,000 in your pocket, and if you'd like to see $15,000 when you wake up tomorrow morning, then how much money you'd have to draw from your ATM? How much money you'd need to add to $1,000 to make it 15,000? Tell me. You'd need, so your adjusting entry would be for $14,000. You with me? See, beginning balance was 5, amounts used 4, still left over $1,000, and I need to see $15,000 there. My management said that they want to see $15,000. So I just make new provision or new allowance of $14,000. So your journal entry is not going to be for 15, your journal entry is going to be for 14. So you debit bad debt expense of $14,000 and credit allowance for doubtful accounts of $14,000. So that's your journal entry for $14,000. Although the percentage of receivables led to $15,000. The percent, when you apply the percent on the amount of receivables, say your total accounts receivable is $100,000, and they asked you to make 15%. So your desired amount was $15,000, and we're going to see $15,000 if we just set aside 14, because we already have 1,000. We have $1,000 there, so we don't need 15,000 more. We need only 14. Now, I know there are some smarter students, those who are going to exceed and may have already exceeded me as a teacher. See, I'm a student as well, and I'm just dying to be a student back again. That's a different desire, though. So those students, why I refer to those? I'm sure there are some of you who are thinking that, sir, you're very clever. You cleverly assumed this to be $4,000. You had $5,000 and you wrote off only 4. What if you wrote off 14? What if reality forces you to write off $14,000? You can write off $14,000. So what did that mean? That would mean that you had a beginning balance of 5 and you subtracted 14 from 5. It is possible. You just keep debiting the allowance account. So every time you write off, your debit allowance account and credit accounts receivable. So your allowance was the 5,000 would have disappeared, and then the allowance account would turn into a debit balance of $9,000. So 5,000, I'm not going to do it in a different way. If I had a beginning balance of ADA, January 1 was still $5,000 less written off 14. So if you write off 14, which is possible, remember the writing off entry: debit allowance account, credit accounts receivable. So I have written off $14,000. But that would mean that my ADA balance now turned debit. ADA debit balance is $9,000. So remember this. Remember the debit nature, debit identity of the ADA balance. 5 minus 14 is -9. So ADA account is a credit, is a natural credit account. When you break the nature, then you change your color, isn't it? Huh? When you break it, so you change your sign. You're no longer on the correct side of the road. Can you see? Like in America, we drive on the right hand side of the road. So if you're driving with the flow, the traffic flow, you'd be on the right hand side of the road. But if you have an accident, say for some reason you have been spinning across the midpoint, and now you slid into the left hand side because you didn't have enough money in your cookie jar. Your prior year, your predecessor accountant or you yourself last year weren't as well. No one can whenever we estimate means estimates are bound to be at variance with reality. So we have estimated that $5,000 would be enough, but now more and more people are defaulting. A total of $14,000 have been defaulted. So now we have a debit balance. My cookie jar is now negative $9,000. And then my management said, I want to see $15,000 reserved there for next year. That's how we'd like to prepare ourselves for next year. So you have your -9, but you need to have positive 15. So your adjusting journal entry would be, so we call it new reserve or adjusting entry. Adjusting entry is going to be, so -9 to 15 is going to be for $24,000. So now ADA was Debit $9,000. If you credit it by 24, so credit 24, now you have a credit balance of $15,000. So that's your ADA, December 31. So please see the two. This one was in normal times, $5,000 beginning balance, $4,000 written off, and $14,000 replenished would lead to a balance of $15,000 for next year. So $14,000 would be the adjusting entry. All right. Now here, we started with the same balance, same beginning balance, $5,000, but we wrote off 14. So we ran out of money and we are in deficit. We changed our direction. A credit balance, a natural credit, has become a debit balance account, debit $9,000. Now, from $9,000, I need to get to $15,000 credit on the other side. You see, you're not at 0 point. You are negative 9. So from negative 9 to positive 15, you need to travel 24,000. So from negative 9, see 9,000 debit to 24,000 credit. Sorry, to 15,000 credit, you need to credit it by 24. So there's the adjusting entry. That's what you need to provide for. $24,000. Okay. So it's possible that your actual adjusting entry would be greater. I mean, the number, the amount of the adjusting entry, or the amount that you're going to set aside at the end of the period is going to be greater or smaller than the computed amount of percentage of receivables, than the desired amount. The desired amount is the end of period balance. And if we do a ledger, we're going to see $15,000. Easy, like $5,000 credit, then $14,000 debit would lead to $9,000 debit. Now you have $24,000 credit, so your final credit is going to be $15,000. So do a ledger, you find the same. All right. So we are now back to these drivers. So these three factors are very important. So please, remember these three, that the actual amount set aside, or the actual amount of expense for the new creation would be driven by these three drivers: how much beginning balance we have and how much we wrote off. So beginning balance minus written off is going to be our ending balance, closing balance, and how much you want, how much you desire to have at the end of the period. This is what you have. Like you have 1,000, you desire to have 15, so I'm going to give you 14. You have minus 9, you want to see 15, I'll have to give you 24. All right. So once you know the amount, then this is the journal entry. Allowance, so you can see allowance created or bad debt expense is bad debts. That would be equal to, so this is the formula. Allowance created or bad debt expense would be bad debts written off. Yeah, this is an ingenious formula that I'm going to introduce you. See, I've shown you this. I've shown you that, okay, your beginning balance minus written off gives you your current balance, and then you compare it to your desired. See, you don't compare it to your desired amount is here. So you have 9,000, your desired is 15. So you have to work backwards to find out 24. This is the problem here. You have to work backwards. Beginning balance minus amount written off. And then you have to compare it with your desired balance. Then you work back and find out that, oh yeah, I need 24. The same here. You can see your beginning balance, 5 minus 4 gives you 1. That 1 and 14, the 14 was not, we didn't know 14, we knew 15. So 1 and 15, so you have to write 15 here and have this blank and then work backwards to find 14. But one of my school teachers, back home in Bangladesh, he gave an ingenious formula. His name is Salahuddin sir. Salahuddin. Assalamu alaikum, sir. If you are still there, and I know that I just found out a couple of weeks ago that you are still well and alive and in good health. So I'm very, very, very glad to know. And next time I visit our village home, I'm going to visit you. But I'd like to pay tribute to the knowledge that you imparted. He gave this ingenious formula. He said, what your bad debt expense that you're gonna, like your adjusting journal entry, or the new amount, the amount that you're going to create now is computed by this formula. I said, write down your bad debts written off. So bad debts written off plus new reserve less old reserve. He used to call it reserve, but I replaced his reserve by allowance. So bad debts written off. Bad debts plus new allowance. New allowance means desired allowance. New means desired allowance, not new creation, not newly created allowance. Because our search is the newly created allowance. How much we would like to create. You can say allowance created is equal to. So that's what we are looking for. And we have all these three numbers, so we don't need to go backwards. You have to simply write down your bad debts written off. For example, here, bad debts written off was how much? $4,000. Bad debts plus new reserve. So new reserve is the new desired reserve. Desired was 15. Bad debts written off plus new allowance or desired allowance is, so that makes it $19,000 minus old allowance means beginning allowance, and our beginning was 5. You can see, so beautiful. It makes it $14,000. Bad debts written off plus new reserve means desired reserve minus old, how much you already had there, Okay, so 4 plus 15, so I need 19, I already had 5, so newly created is 14. And if you want to use the other example where we had written off, remember how much we wrote off? We wrote off 14 there. So $14,000 written off. See, we wrote off 14 plus desired reserve is 15. Bad debts written off plus desired minus old. So 14 plus 15 is $29,000 minus old was 5. Beautifully gives me $24,000. So it has to be newly created. See? So you remember it for life. I remember it since I was a kid. Since I was, I think, about 13 years old. So it's amazing. If you have a good teacher, then they can change your lives. Well, so bad debts plus new reserve less old reserve. Remember it. I haven't seen any textbook saying this. I don't know how he discovered it. Bad debt written off plus new desired. So 14,000 is written off plus 15 makes it 29 minus at my disposal I had only 5. So I need to pour in $24,000 of more bad debt expense into, of course, more allowance. Perfect. Okay. So we now know how the formula works. Okay. Excuse me. So after that, we now have a couple more slides. So now that estimation, the say 3%, 4%, or whatever percent of your accounts receivable is established in a more can be established in a more professional way, because it's no one is a mind reader. Only God knows what our customers are going to do. But there is something called experience. There is a thing called track record. So your past could be a barometer, could be an indicator of your future behavior. In most cases, not in all cases, because people do change. Sometimes Okay, so aging schedule is one of the more neat tools. All right, what is an aging schedule? What it does is, let's say you have 50,000 customers or 15 customers. Some are just new, you just extended a credit for them. So you don't know whether they're going to be late or whether they're going to default, but you know that, everyone, the guy who's, for example, who's going to die today was a newborn one day, like several decades ago. I was a newborn. Now I'm not anymore. So I'm jaded, of course. So we classify all the customers, all the accounts, based on how old their due is. So your account is, say, only 15 days past due, or not past due at all. It's only 30 days. So not past due. So you're supposed to pay, say, the first week of next month, and it's not even first week of next month. So whether you are not past due, then 1 day past due, 30-day past due, 60-day past due, 90, 180, 365 days past due. So usually we track up to 6 months. So this is an example of an aging schedule. You can see not past due at all. And we have a lot of customers there, $600,000. And I put 0%, but more practical, more pragmatic accountants would put 1% on there too. Because some of these that are born today, some of the guys, some of the wonderful babies that are born today are going to be, unfortunately, some of them are going to be notorious criminals. It's possible, I mean, I pray for them not to be, but it is possible. So we need to prepare ourselves. Remember, the whole idea is bracing for a possible non-payment, for possible default, for possible trouble. So we need to take those precautions. So a more pragmatic one, as I said, would put a percentage here. It would be tiny, because we're going to reassess them as we go. All right. So not past due at all. In my slide, there's 0%. Then 1 to 30 days. This is the total amount there. Maybe 15 customers, accounting for $310,000. So 1% of that. And then there's some money here, $200,000. They are 31 to 60 day past due, and then it goes on. You can see the longer you go, the number, the percentage goes up, because these guys, they have been past due by more than 180 days, although they're $11,000, but I'm anticipating 80% of it to be uncollectible. So you can see there's an inverse relationship. I mean, there's a positive relationship between the aging and the likelihood of default. The older it gets, the longer it takes, the higher is the likelihood, the greater is the likelihood that they're going to default. So the credit risk increases, default risk increases. All right. So once you have this, it's more classified like, you go by their merit. So calculate 0% of this, then 1% of this, 8% of this, 16%, 40% of their corresponding amounts, and add them all up. So once I have done it, I found that my total amount, the desired amount, this is not the adjusting entry amount. The desired amount is going to be $58,300 of my total $1 million worth of accounts receivable. So it's not a wholesale percentage. It's not 1% or one size fits all. Now you can, of course, convert it into a percentage, like $58,000 over 1.25 million would be some percent. But we went more by the merit of it. The older it is, the greater is the percentage. And then we calculate, we compute and find out that the total amount that we need to see to brace the storm. At the end of this period, we'd like to see that we are in the cookie jar, we have $58,300 in the ADA account. Okay. All right. And once you have that, then this is colorful. I just wanted to add some color. Because life, accounting is generally not very colorful, and life in general is not either. That's the sad reality of life. So let's see. So you have beginning ADA. It's an example, real example. Beginning ADA is, say, $25,000 credit. I would like you to to have some examples or to think that what if your beginning is also debit? Possible. You have to be prepared for any possibility, any, in the range of possibility, any casualty. But if you want to be a CPA or a CMA, if you want to be a chartered accountant, certified public accountant, then you'd be dealing with all possible scenarios. There are millions of businesses. Not everyone is going to have some set aside there at the beginning of the year. They might not have followed the, they may be switching from one method to the other, or maybe they didn't set aside any money, or maybe they were already at a loss, already suffering from a loss, and they decided that we can't afford to set aside any money. So they're, or maybe they have set aside some money, and then right at the end of the year, there was a big default, so the account turned debit. Anyways, I have a more sane account here, more sane balance. ADA balance was say $25,000. Credit means some money is there in the cookie jar, and then we have written off these 3 customers. Great names, David Jones, and the second one is Zara, the fashion store in England. Zara, you know the store, Zara. I've seen some in the US as well. So Zara had Zara Williams, and not the real Zara. There's $5,000, and Gary Preston, a more everyday name, $12,000. So 3 customers together, accounting for $20,000, have been written off. So we have decided that they're not going to pay. So we struck the names off our list. So $20,000 is gone. So from 25, if $20,000 is gone, then how much is left? 5. Remember, $5,000. And then your estimated allowance is, say, $82,000. I'm not using the same 58. I'm not using this number. I'm not using the same $58,000. It's a fresh example. So we decided that 20% of our total accounts receivable, which was $410,000. So 20% of 410 is $82,000. So we want to see 82. This is not how much you are creating. This is what we would like to see. You see my point? So you have already done 50 credits, but you'd like to graduate with, say, 120 credits. So just find out how many more credits you have to do, you have to take, because you're already somewhere into there. So we had $25,000. We used up 20. So you're left with 5. Now I'd like to see 82 there. So if you have 5, you like to see 82, then how many more you have to set aside? 77. And you can see 77 is the journal entry. Well, I don't have the journal entry here, but 77 would be the journal entry. And again, let's see Salahuddin method. Salahuddin sir said bad debt written off 20 plus new allowance. New means desired allowance, 85. So 20 plus 85 minus your beginning balance, old allowance. Bad debts plus new reserve less old reserve. That's what he used to say. And that's what he memorized. It's in my mind. He used to use the word reserve, and every time I iterate this formula, I pronounce reserve. I should say allowance. I'm in America. It's important to conform to standards and the vocabulary. All right. So bad debts written off, bad debt plus new reserve less old reserve. Remember, bad debt, $20,000 plus desired. I'd like to change his new to desired allowance. So desired allowance of 85. So sorry, 82. So 20 plus 82, 82 that is. From here, I see actually the mirror image of the numbers. That's why 82 looks like 85. So 82,000. So 20 plus, how much was it? Yeah, sorry, 25. Sorry, yeah, 25 was the beginning balance, but bad debts written off was 20. So 20 plus 82 is 102 minus beginning balance old reserve 25. is 77. You can see I've done a more formal calculation here. That your beginning balance was 25 minus you wrote off 20, so you're left with 5, and your desired is 82. 5 to 82 is 77. 5 to 82, you're on, say, milestone number 5, and or exit 5. Then you need to meet someone at exit 82. So how many more miles you have to drive? 77. All right. But if you, for some reason, if you went backward, if you're in negative territory, so -5, you need to get to 82 positive, then you'd have to do 87 miles. All right. So I hope this is clear. So I'm holding it for a more moment. If anyone wants to see or read. What's wrong? It's changing the focus. Got it? Bad debt plus desired allowance minus old allowance means beginning balance is your bad debt expense. And bad debt expense is what is allowance for doubtful accounts. So wonderful journal entry, debit bad debt expense, credit allowance for doubtful accounts. There's the adjusting entry. That's what creates new allowance. And if you have something already there, then that plus this new one would lead you to the desired balance. All right. So I think in terms of the conceptual discussions, I'm done. But I wanted to show you one example. So for my, specifically my students who are using the Warren Jones Tyler textbook, Managerial, Financial, and Managerial Accounting, the 15th edition book, I have the solution to exercise 814. Exercise 814 solutions here. So initially there was something written off. This was a series of journal entries, series of transactions. So the first question was that we wrote off someone for 8,440. That was KQ. So I'm not going to get into reading out the question. So see how you write off. This is write off, not creation. That is a bad debt expense, debit, accounts, receivable, credit. So now you could say that why bad debt expense? When I write off, you showed with debit allowance and credit accounts receivable. But this problem requires you to do everything under the direct write-off method first, and then do the same under the allowance method. So you're going to see a rerun of the same. So first we do everything under the direct write-off method. So under direct write-off method, no allowance has ever been created. So debit, bad debt expense, credit, accounts receivable. And then we had another one. So this customer owed us $12,500, and they have come back. They've come with $3,000, and we don't think that they're going to ever pay the remaining $9.5. So debit cash for the amount that you received, and debit bad debt expense for the amount that you are unlikely to receive together is $12,500. So strike them off. So their name goes off the list because this is more or less you like to clean it up. Okay, pay me whatever you can, and then I'm going to write off the rest of it. All right, either you forgave them this, or writing off your accounts receivable doesn't mean that you have excused or forgiven the debt. You have other actions like legal actions or other things that you could take. So it goes to the other department. But from as far as accounting is concerned, we have cleaned it up. It's not a part of our accounts receivable anymore. So there's the second transaction. Someone who owed us $12,500. They gave us $3,000, and we wrote off the remaining $9.5. So again, bad debt expense. Then the third one was what happened. This guy that we wrote off, they suddenly came back with the money. So when they come back with the money, as I said, there will be two journal entries. One is reinstatement. So debit accounts receivable. Credit bad debt expense is a simply reversal of this entry. Just flip this entry, and you're here. So accounts receivable goes back up, and bad debt expense is credited, means that's cross cancel. And then now collect the money, debit cash and credit accounts receivable. And then we write off some more people here. You can see 5 people together is $24,955. So debit bad debt expense again, and credit accounts receivable, WD, GG and AK and all these names. So the bottom line is that under the direct write-off method. Every time you write someone off, you debit bad debt expense and credit accounts receivable. So these 5 people are now written off. Fine. And then no adjusting entry. You just leave it like that. And then we have the same thing under the allowance method. So start with the first one, assuming that there is some money in the allowance account. So whenever someone is deemed uncollectible, we don't debit bad debt expense anymore. You can see. So compare the two. See here. Here you debited bad debt expense. Here on my left hand. Here you debited bad debt expense. Here you're debiting allowance. Can you see? You're debiting allowance. You're not debiting bad debt expense. Here, debit allowance of bad doubtful accounts. Here you debited bad debt expense. So the same thing happened here. Same transaction. The customer is deemed uncollectible. Debit ADA, credit accounts receivable. And then second one is someone who owed us 12.5, came back with $3,000. So we debited cash for $3,000. And again, for the writing off portion, we are not debiting bad debt expense. We are debiting allowance for doubtful accounts, so ADA debit, because we have money in the cookie jar in the ADA account. So debit allowance for doubtful accounts, ADA, and credit accounts receivable. And then that guy comes back. So we reverse the, see there we reversed, we debited accounts receivable, but credited bad debt expense. But we are not crediting bad debt expense here because we didn't debit bad debt expense at the first place, in the first place. So simply reversing this here. So debit accounts receivable, resurrecting or reinstating it, and credit allowance ADA. Fine. Once you have reinstated, now you collect the money, debit cash and credit accounts receivable. Yeah. Debit cash, credit accounts receivable, and then 5 guys are written off. So debit ADA again, no bad debt expense. Every time you write someone off, you debit ADA under the allowance method. No bad debt expense. Bad debt expense is only recognized at the end of the period to create, to replenish the jar, to put more in the jar. And every time you eat out of the jar, no more expense. Under the direct write-off method, every time you write someone off, you have an expense because you have never anticipated and you have never had a jar, had anything in the jar. You know, it's like if you feel like having say peanuts, you go and buy peanuts. But if you are more conservative, one of the old school guys, then you would have a jar of peanuts, and hopefully they're dry and crispy, or a jar of trail mix, we call it here, like dried fruit or dried anyway, nuts and fruit. So debit allowance for ADA and credit. The reason I said that is that there must have been money in the ADA account. See how many times we needed that. We needed ADA account here, and then although we got it back here, but we needed some more money here. So ADA must have had some balance. Okay. And then we are given an aging schedule, the same one. You'd see that, okay, these are total receivables, $515,000, and they asked us to prepare an aging schedule. Aging schedule, so we did the aging schedule, you can see. For this group, this class 1%, then the second class 3%, 10%, 33%, and 75%. So different classes of debtors, different classes of accounts receivable, different classes of customers, based on how long overdue they are. The total amount that we can see there is $47,090. So this is important. This $47,090 is not going to be the amount that you're going to see in the adjusting entry. This is the desired balance. So that would be, if you do an ADA ledger, you'd see the closing balance is this $47,090. So this is the desired amount. Fine. Now, they gave us additional information. They said that during the year, at the beginning of the period, we had some $36,000. So if you go back to the problem, exercise 814, you'd see that this is page number 428 of the 15th edition of Warren Jones Tyler. Warren Jones Tyler, Financial and Managerial Accounting, a Cengage textbook, 15th edition, page number 428. So under requirement B, they told us that our beginning of the period balance was $36,000, and they haven't told us that this is what we wrote off during the period, because they expect us to be able to track from these journal entries and find out how much we wrote off. We know, how much we wrote off. We wrote off some 8,400 and some amount at the beginning, then we got it back, so that's gone, that's canceled. But then from the second guy, $12,500, that guy, we received only 3 and wrote off the remaining 9.5. So remember that 9.5. And then at the end of the period here, you can see here we have 5 more people. So we wrote them off too. Yeah, we used allowance to write them off, but we did write them off. So remember that. How much you had, what was your beginning balance, and how much you wrote off. All right. So we wrote off. I'm going to use Salahuddin formula. Salahuddin sir formula. In our culture, it's rude to call the sirs by their names, and I see that in the South here, this is the culture too. Our students call us Professor, Dr. Kareem, and all those. Which makes me quite uncomfortable, because I grew up in a culture, especially in New Zealand and then later California, where people call people by their first names. So like in New Zealand, if you call someone Dr. Kareem, they would be, you're being so formal, and there must be some bad news for me. Why are you being so? Why are you so formal? All right. So Salahuddin formula, or Salahuddin sir formula, starts with bad debts written off. Okay. So that's the beginning. See how much we wrote off. 9.5 with the first guy, and then 24,000, 24,955. So we wrote off a total of $34,455. So that's bad debts written off. Plus desired allowance. Desired allowance is here, 47,090, you can see. So plus the desired allowance. So bad debt written off plus desired allowance. So add the two together is how much? This 81,000 some amount, minus old reserve or beginning of the period balance. So we had $36,000, so 81,000 minus 36 gives you this. This is the money, this is the amount that you have to create, you have to set aside now. You have to set aside now. So that's the amount that's going to feature in our adjusting journal entry. Not the 47. You won't see a journal for 47,000. You see a journal entry for this. So bad debts written off plus a desired balance, new reserve, desired reserve, minus old reserve, means beginning of the period balance, will give you the amount that you need to plug in the adjusting journal entry. All right. So let's continue. And that's how the journal entry is. You can see, I told you that the amount is going to be this. How much it is? 45,545, isn't it? 45,545. And see, I mean, the reason I'm hammering on this for so long is that this is how people struggle. They say that, well, my aging schedule tells me that I need $47,090. And then my journal entry doesn't see that. My journal entry, how come the journal entry is for a different amount? And there's a reason, why they are puzzled and why we spend so much time. If you do a, like in the other method where you start with the beginning balance minus, see how much you wrote off and see if there's any left over, and then see what's your expectation now is, and find out how much you need to meet your expectations. That's also a different way, another way you can do it. So the journal entry now would be for 45,545. This amount. All right. So, and you see there's the amount here. Debit bad debt expense, credit ADA. Debit bad debt expense and credit allowance for doubtful accounts. Okay. So this is, and then there's a new requirement, or a third requirement C. C said, okay, how much the net income would be higher or lower under one method versus the other. So I wrote the total bad debt expense. Remember, bad debt your net income is affected by your expense. Anything that goes in the income statement, whatever goes in the balance sheet doesn't change your net income. Your net income is affected by your revenues and expenses. So bad debt expense is the nomenclature, is the title that we need to watch out for if we'd like to see the income effects. So bad debt expense under the direct write-off method. If you go back to the original slide, I can show you bad debt expense here, I think. No, that's continued. So here. So bad debt expense, you can see right at the beginning, there is a bad debt expense, which was reversed, of course, here. I think when the guy came back and paid us back. Yeah. So that original 8440 is reversed. So so don't worry about this original first bad debt expense. But worry about this bad debt expense. There's 9,500 here and 24,955 there. So those two, 9.5 plus 24,955. And I actually wrote it here for your understanding. So these two together is the bad debt expense under the direct write-off method, which is 34,455 under direct write-off method. So that's our expense. But under the allowance method, the bad debt expense is 45,545, much higher. So higher expense means lower net income by how much? So I took the difference between these two, and that was $11,090. So I wrote it that since bad debt expense under the direct write-off method is smaller than that under the allowance method by $11,090, the net income under direct write-off method is going to be higher by the same amount, or net income under the allowance method is going to be lower by $11,090. Okay, so that's what ends our discussions, ends our problem solving. But I'd like to show you the other method of getting to that allowance amount, bad debt expense amount. So we used we use Salahuddin formula here. Bad debt expense plus, bad debts written off plus desired allowance minus old reserve or old allowance. So here I'm going to do, I'll start with my beginning balance. So our beginning balance was $36,000. So you can see the last number under Salahuddin formula is going to be the first number in the new formula. So start with the beginning balance minus, see how much you wrote off. So we wrote off 34,455. We wrote off 34,455. So 34,455. So that leaves us from 36. If you take off 34,455, I have to do it on camera, this mental math. So I think it's $1,500 or little more than $1,500. So 1,545. So that's what is left over. Left over. After, so your beginning balance of 36 minus what you wrote off, 34,455. All right. Wrote off 34,455. So that leaves you with 1,545. And now your desired amount is so much you need. Your desired is 47,090. 47,490. So you work it out. You have 1,545. See your beginning balance of 36 minus you used up 34. You're left with 1,545, and you're going to get to 47,090. So 47,090 minus, I'm not going to risk embarrassment by trying this subtraction on camera. So I have 1,545. I need 47,090 minus 1,545. So I need to create an extra 45,545. And that is exactly the amount that we had under the Salahuddin formula. So your beginning balance minus what you used up minus or the absolute difference between what you have and what you need. Take the absolute difference. Oh, well, I don't think you need to. I'm sorry. The absolute difference could be misleading because the absolute difference would work if your leftover is a credit. But what if we had 36, but you used up 45? You can use up 45. It would just become debit, instead of a credit, like bank overdrawn. If you have some money left there, it would show a credit balance. But if you have withdrawn more than what you have, it would show a debit balance. but sometimes they would teach you. So our accounting system would allow us to write more off than what we originally have in the cookie jar. All right. So 1545 and 47 is what we desire. So the absolute difference, or the difference between these two, would work only when your leftover here is credit. But if the leftover is debit, then the absolute difference won't work. Then you have to have a signed difference, because what if it was minus negative 1545 or debit 1545, and to get to 47 you'd need almost like $48,500. So we need now 545, and you can see the Salahuddin formula is also 45, 545. So I would stick to my Salahuddin formula: bad debt plus new reserve less old reserve. Okay, so bad debt is what's bad debt's written off during the period, plus desired ending balance, minus my beginning balance, what I already have. All right, so that's what closes, I think, our discussions here. And it's been a good couple of days. I mean, I've been preparing these hard, what do you call them? The slides, my manual slides, for last couple of days. But I hope you have enjoyed the discussions, and I'm sure more practice is necessary. But what I would like you to notice is that you have to debunk the mystery of the allowance method, especially the percentage of receivables method. Percentage of sales method is straightforward. You compute an amount and you write the journal entry for that. And whatever that leads to a balance, the idea balance would be different, because it would depend on how much money you had, then how much you used up, and you have now set aside the percent of sales. But percentage of receivables, for some reason, is tricky, is more difficult, because when you apply a percent of your receivables, then you're basically saying that this is what I'd like to see when I close my accounts and go home. So I'd like to see $70,000 there in the ADA account for next year. Now, if I already have 65, then I need to create only $5,000. But if I have minus 65, then I'd need $135,000. But the management is saying that whatever you need to do it, but we'd like to see $70,000 in the cookie jar, so that we have enough to face any defaults. In other words, this also, this has some signaling role. If you introduce a little bit of finance here, signaling means when you see an ADA balance, desired ADA balance, then you could read management's mind that, okay, management thought that this amount is going to be necessary to fend off any defaults. That means you yourself can anticipate how much the management is thinking their defaults are going to be. And then you can also judge the quality of management, their wisdom, if you look at how much they set aside every year and how much actually bad debt they wrote off. Have these two been correlated, highly correlated? You'd expect them to be highly correlated as a sign of good management, or wise management. But if they have been all over the place, then you'd know that they're out of touch. So whatever you do, you communicate a lot of messages. Everything communicates. So your accounting treatment, especially the judgmental ones, where you apply discretion, they tell a lot about what you think your customers are going to do. So remember, everybody's watching you. You have, especially for listed companies, we have investors, we have financial analysts, we have stockholders, shareholders, institutional shareholders. So many smart people, and also a lot of academics are following you. Anyway, I don't want you to follow me anymore for any longer. Tonight, we end this, and I must thank you for your patience. I know that my discussions are lengthy, and but I'd like to express what I have, what I saved in my mind, because usually when I prepare a video, I keep thinking about what I'd like to say. So I wanted to say what I said, and I hope you find it useful. And only then my hard work, or whatever energy I spent, is going to be well spent. All right. Have a good night. Cheers. Bye-bye.